Okay, guys, welcome back. This is part two of professional conduct. Remember, professional conduct is a three-part series. So, if you haven't watched video one, I would suggest that you go back and watch that. In this part of our discussion, we are going to be looking particularly at part two and part three. We want to try and understand what part two and part three hold for chartered accountants and auditors in general. And let's see if anything that we learn here can apply to us as students as well. So let's get straight into part two. So, first, to understand the idea of a chartered accountant in business, we must know that a chartered accountant in business is offering his professional services to his employer. So his services are not for sale. It's not the product that is being sold. Instead, he is enriching his employer by the use of his professional accounting services. This becomes very important because there's a big distinction between chartered accountants that are in business and chartered accountants that are in public practice. Public practice is when the chartered accountant is actually selling the service of accounting. So let's look at the first issue that we're going to deal with under chartered accountant in business, and that issue is conflicts of interest. Now, what exactly is a conflict of interest? A conflict of interest is when a chartered accountant has two opposing views or thoughts on a particular matter. Now, the code tells us that a chartered accountant must avoid any situations that may result in a conflict of interest and that may compromise his professional or business judgment. So basically, when executing his services as a chartered accountant, he must avoid the interests of other parties and himself interfering with the interests of his company. What might create a conflict of interest? Well, one may have entered into a relationship with someone that creates a conflict of interest. For example, if you enter into a business relationship with your wife, or your wife is the major supplier to your company, that can affect the way you treat that business relationship. We must ensure that the chartered accountant in business is exercising their full professional judgment and is alert to all interests and relationships that may be considered to be a conflict of interest. And what is the test? We look for the informed third party test. What does this mean? The informed third party test is when an informed third party, meaning someone that is having no relationship to the current issue, if that person were to view the issue and consider the chartered accountant to be biased, then there is a conflict of interest. We talked about the informed third party test when we spoke a little bit about independence in video 1. When we're talking about type 1 and type 2 types of conflicts of interest, this is very particular to the CA in practice, but we'll briefly touch on it now when we're talking about CAs in business. Firstly, type 1 is where the professional accountant provides professional services related to a particular matter for two or more clients whose interests in the respect of the matter are conflicted. So what does that mean? That means that you are providing services to, for example, two competing companies in the same sector. In that case, you are providing services to two people that are competing with each other, so their interests are conflicting. How might this apply to a chartered accountant in business? Well, you may be reporting to a boss who is the CFO, as well as someone who is in charge of sustainability. CFO's interest is to create as much money as possible, whereas the person who is in charge of sustainability may be requiring that the business acts in a more moderate way towards creation of value. That's type 1, where the chartered accountant is providing services to two different types of people with conflicting interests. What's type 2? Type 2 is the interest of the chartered accountant in respect to a particular matter and the interests of the client to whom the chartered accountant provides professional services are in conflict. So this is where the chartered accountant has a difference with the person that they are providing services to. These two will be explored in more detail when we talk about chartered accountants in public practice. So, how should a chartered accountant deal with conflicts of interest? Well, in order to eliminate or reduce the threat to an acceptable level, the chartered accountant might consider withdrawing from the given engagement. They may consider restructuring their responsibilities, or they may disclose to the involved parties that they are conflicted in some way. Another thing is that the chartered accountant may request that they received review or oversight on the work that is performed by them. Finally, if the chartered accountant is left with no option, they may approach SICA for some relief or seek legal counsel from a lawyer. Remember when we spoke about disclosure, we said that the code often tells us what to disclose. If a chartered accountant were to disclose to the parties involved that they have a conflict of interest, the code tells us what they should say. So, they should indicate the nature of the circumstances that gave rise to the conflict of interest. They should also indicate if there are any safeguards that the chartered accountant has applied to reduce the threat down to an acceptable level. And they must obtain consent from the parties involved in order to proceed with any professional services that are being offered. So, the majority of chartered accountants will be required to prepare some sort of financial information. They may also be involved in preparing and reporting to the public. This is a key part of what it means to be a chartered accountant, and so this section 220, actually weighs in on what a chartered accountant needs to bear in mind. The first is that the information that they produce must be honest and truthful. So it must reflect circumstances honestly and must give the users of the financial information a clear picture of what is happening. They may be required to exercise some judgment, professional judgment, when they're looking at things like estimates and that sort of stuff, but when they are exercising their judgments, they must ensure that it accurately and completely reflects material aspects of what they are dealing with. They must also ensure that it's true to the nature of the business or the transactions that they are dealing with, and classify and record information in a timely and proper manner. This means that the chartered accountant does not lax in the way they record. They need to ensure that they record their information as fast as possible. This may mean managing their staff in such a way that ensures that they record financial transactions quickly. The chartered accountant may also not omit anything with the intention of rendering the information to be misleading. That means that they cannot lie by omission. They also need to make sure that all the information that they provide is in line with IFRS or other reporting frameworks that may apply. So, remember we said that when a chartered accountant is preparing financial information, they may need to exercise some judgment, particularly when it comes to accounting estimates. The key thing is that when the chartered accountant exercises such professional judgment, they must ensure that it's not done in a way that misleads someone that is reading the report that is being prepared. They also, at times, may be forced to rely on the work of other accountants or others that are not accountants. When they're relying on such work, they must take into account the reputation and expertise of the person that is preparing the information. They also must ensure that the person has applied all professional and ethical standards in the preparation of such information. This ensures that the chartered accountant is not liable by extension, which means that the chartered accountant is liable because they've used information that is incorrect. What type of threats may arise? Well, very often in the working environment, there may be intimidation threats, where the CFO or CEO may pressure a chartered accountant in order to report things in a specific way that makes the company look good. This would be considered an intimidation threat. How should a chartered accountant go about eliminating such threats? Well, of course, if the chartered accountant has a threat that they can escape, they should try and withdraw from the engagement as fast as possible. They want to make sure that information that they provide is straightforward, honest, and true. And if they can logically see that this is not possible, then they should withdraw. In other cases, the chartered accountant may want to consult with other people in the firm or with SICA in order to identify how they may obtain the good and correct information. Things that they should consider when evaluating information that they receive is whether the information is correct based on the underlying data. What do the users of such information already know? They should also consult the policies and procedures of the organization in determining if internally generated information is accurate. You will notice already that there are some generic safeguards that can be applied. For example, approaching a professional body such as SICA, or gaining legal counsel, or removing themselves from the engagement. These are what we call generic safeguards and will apply to most cases. The next thing that we want to look at is how should the chartered accountant act with sufficient expertise. Now, this is a very important thing because as a chartered accountant, they are the expert in the room when it comes to financial reporting. And it is their responsibility then to ensure that they have the necessary training, the necessary education, as well as the necessary expertise and experience in order to execute their duties. This places the responsibility on the chartered accountant to keep their knowledge and their expertise maintained at a very high level. If they do not have the expertise or knowledge that is required to execute a specific reporting requirement, they are then forced to go and obtain it somehow. This particular guideline focuses back on our fundamental principle of professional competence and due care. Remember, it is in the accountant's self-interest to ensure that they are professionally competent, but also it may cost the accountant some money in order to get additional training. So, the accountant needs to make sure that they have the sufficient education, resources, and time available in order to execute their duties. If this is not the case, they may be faced with a self-interest threat in order to gain those items before they execute their duty. What types of safeguards might they employ? Well, the first is that they should continually train themselves. They should also ensure that there's significant time and resources for themselves and staff members in order to execute their duties. The professional accountant should refuse any assignment that goes beyond their experience or skill. This will reduce the threat that they may be able to produce. This will reduce the threat that they produce incorrect information. So now let's look at financial interests. Financial interest, compensation, and incentives linked to financial reporting and decision making. What does this mean? Well, sometimes a chartered accountant will be paid their salary based on the way their company performs. This is a very dangerous way to remunerate a chartered accountant. Why? Because a chartered accountant is able to manipulate the reporting in order to make it look like there is a benefit or there is a value being created in the company. As a result, there are some guidance given to chartered accountants in this way. Where a chartered accountant in business is being remunerated by the employer in a way that incentivizes them to make arrangements or changes to the financial reporting, the chartered accountant should neither manipulate the information or use confidential information for their personal gain. This is the creation of a self-interest threat. The chartered accountant needs to understand that the threat is present and work actively to eliminate the threat. This may also apply if the chartered accountant's close family member or friend is going to receive the financial interest. So, what examples are there of such threats? Well, if a chartered accountant holds some sort of financial shares or interest in a company, then they will be remunerated or gain some sort of benefit if the company's share price does well. If the chartered accountant is given a performance or profit related bonus at the end of the year, they again will be remunerated if the company does well. If there are deferred bonus share rights, that means that a chartered accountant only receives shares if a specific target is met. These are sometimes called in math share options. The threat might also exist if there is simply an opportunity or incentive to manipulate information. So, how should a chartered accountant deal with such situations? Well, the first is that the chartered accountant should look at any independence policies, or procedures put out by the company in this regard. They may also want to contact senior employees or management and indicate that they are somehow conflicted. They also want to look at the size of the financial interest that they are going to gain. So, for example, if it's just 1 or 2 rand, it would not be material enough to warrant the chartered accountant making any changes. So, they want to view the situation in a realistic light. And ultimately, the chartered accountant may want to remove themselves from the situation by withdrawing or limiting their services that are offered. Next, let's look at inducements. Now, inducements is just a fancy way to say gifts. It's called inducements because when someone gives you a gift and expects you to do something, that is called inducing someone or placing pressure on someone to do something for them. So, a chartered accountant should remove themselves from a situation that they may be induced. Inducements may come in the form of gifts, hospitality such as holidays, preferred treatment, or any undue influence. A chartered accountant has the responsibility to remain alert to such threats to the compliance of the fundamental principles and not be influenced by any inducements. On the flip side, a chartered accountant should never offer an inducement to someone else to obtain undue influence on someone else's judgment or behavior. Remember, this is where we look at the third party test. So, what does a independent third party, think of the situation? A chartered accountant should always observe the laws and regulations that are in place with regard to gifts and hospitality. Basically, a chartered accountant should not accept any inducements that may affect their professional judgment. The threats that are created with this type of situation is a self-interest threat, obviously, but a familiarity threat because it creates a stronger relationship between the person giving the inducement and the chartered accountant. It may create an intimidation threat because the chartered accountant may, after having received the gift, be forced to do something for the person that has given the gift. How should a chartered accountant ensure that they create a safeguard? Well, the first is that they need to look at the factors that are affecting the inducement. So, they need to think about the nature of the inducement, what is the size and the materiality of the inducement, what time does the inducement arrive? So, is it very close to the year end or reporting date? They also need to look at what is the cultural and societal pressures on giving such gifts. So, if it's in their culture to give gifts or to induce, then they must identify that this is incorrect. They also need to look at the type of person that is giving the inducement. Is it a powerful person or is it someone who needs to gain some sort of power? How should they eliminate this threat? Well, they can go to higher management if someone lower down is giving them the inducement. They can amend or terminate their business relationship. They can decline the inducement, meaning that they don't accept the gift. They can transfer the responsibility of financial reporting to someone else. They can be transparent with senior management and everyone involved in the way that they are reporting. They may want to keep a log of all the gifts that they have received and the person that is giving them. They may ask for extra oversight or extra reviewers to look at their work. They may also take the inducement or gift and donate it to charity instead of keeping it. And they may reimburse the giver for the inducement. There is some leeway though, because not many inducements are intended to gain improper influence over the chartered accountant. So the chartered accountant needs to be very careful about what and how they treat the inducements. Non-compliance with laws and regulations, sometimes called No-clara. This is a new section of the code. What it basically says is that the chartered accountant needs to familiarize themselves with all the laws and regulations that are applicable to a given company and particularly their role. The chartered accountant now needs to become the custodian of compliance, meaning that the chartered accountant needs to look out for areas of non-compliance with laws and regulations such as fraud, corruption or bribery, even money laundering, and they need to quickly identify it and indicate to those at higher management, or if the higher management are the ones that are doing the wrong things, then they need to go outside the entity and maybe talk to SICA or another body about the non-compliance. Remember, a chartered accountant is not a policeman. However, they need to always be aware of what is going on around them so that they are not complicit, even sometimes unknowingly, to non compliance with laws and regulations. So, once the chartered accountant understands what laws and regulations are applicable to their company, they also need to develop a plan of how compliance will be achieved. This may require the chartered accountant to report the matter to the appropriate authority if non-compliance is committed. Chartered accountants must act in the public interest and the objectives when responding to laws and regulations, particularly their non-compliance. They need to ensure that they comply with the fundamental principles of integrity and professional behavior, which both weigh in on laws. They also need to ensure that they alert management, top management, or those charged with governance in the company. They help them to rectify it, or they indicate that they should rectify it, and they prevent any further non compliance from happening. And they may want to take further action that is in line with the public interest. Many employing organizations have policies and procedures to deal with such reporting. These are called whistle blowing. Chartered accountant may want to take advantage of such a mechanism. So, what types of threats may arise? Well, there may be a self interest threat if non complying with the law actually benefits the chartered accountant, but more often than that, there is an intimidation threat, particularly to the fundamental principles of integrity and professional behavior, which both deal with the law. How does a chartered accountant deal with non compliance of laws and regulations? Well, it depends on their position in the company. If they are senior accountant, what exactly is a senior accountant? A senior accountant is someone who is a director or a public officer. It may be a senior employee, someone that has significant influence in the company with regard to making decisions, buying, acquisition, or employing new people. This is someone who is considered to be a senior accountant. Now, if the chartered accountant who becomes aware of non-compliance is a senior accountant, then what they need to do is they first need to gain an understanding of what laws and regulations are applicable and the potential consequences for not complying with laws and regulations. They may be required to apply their judgment with regard to the laws that are applicable. They may also ask for consultations with a legal representative. This may include someone from SICA. The next is they want to try and address the matter. They address the matter by discussing it with the next level of authority that's above them. So they want to escalate the matter to someone more senior than they are. If they are a director, for example, they may want to go to the shareholders. They should then take appropriate steps to communicate the non-compliance with directors or shareholders. They may want to attempt now to start complying with these laws and regulations by letting the government or reporting agencies know of the non-compliance. They want to rectify and stop such non-compliance to limit the consequences. They also want to reduce the risk of reoccurring non-compliance and also seek to prevent non-compliance that has not yet happened. The senior chartered accountant is then left with the decision of whether they should disclose this non-compliance to the auditor. It may be required that they do so in order to ensure that the auditor understands what has happened. Sometimes further action is needed. The cases that may require further action is if they have not responded timeously to the non-compliance, if they are not in a position to rectify or eliminate the non-compliance, or if the disclosure to an appropriate person is not adequate enough. What types of further actions may be needed? Well, they may want to look at the regulatory and legal framework that is applicable. They may want to ensure that everyone understands the urgency of the situation. They want to investigate how much the situation has affected the company. They want to look at the reoccurrence rate, and if there is any substantial harm to anyone. The senior chartered accountant should use their professional judgment in determining the effects of non-compliance. Next, they should try and disclose the non-compliance to the appropriate authority. In deciding whether or not to disclose, the senior chartered accountant must consider the actual or potential harm that may be caused to investors, creditors, shareholders, and the general public if they disclose that the entity has been non-compliant. Has the entity, for example, engaged in bribery? Is there some sort of threat towards their licensing to operate? Is the entity listed on the JSE? Has the entity created harmful products that are currently being used? Has the entity promoted a scheme that may help them evade tax? These things will determine whether a chartered accountant discloses or not. And finally, the chartered accountant wants to document all that they have identified and the actions that they have taken. Now, that's if the chartered accountant is a senior chartered accountant. What happens to someone that's not a senior chartered accountant? Firstly, what is not a senior chartered accountant? A person that's not a senior chartered accountant will not be a director, will not have significant influence, will not be a decision maker in the firm, will simply be doing finance operations of the entity. This type of chartered accountant must follow step 1, which means they should attempt to gain an understanding of the laws and regulations that are applicable, attempt to understand the non-compliance that the entity has engaged in, and apply their professional judgment in determining what types of consequences the entity might face. After that, they want to inform a senior chartered accountant in the firm. Then their responsibility comes to an end. A chartered accountant should not allow other people to come between them and the fundamental principles. This means that they should avoid situations that create pressure or influence for them to breach certain fundamental principles. The threats that may be created are quite vast, depending on the situation that the chartered accountant finds themselves in. A professional accountant may face pressure or intimidation that creates threats to compliance with fundamental principles. The next thing is the chartered accountant must evaluate the possible threat or pressure for non-compliance with fundamental principles. They want to try and understand the intent of the person that is pressuring them. They want to look at applicable laws and regulations. They want to understand the culture or leadership at the organization. This is where we talk about organizational culture. And then they want to look at the laws, policies, and procedures of that specific entity. How should they safeguard themselves against this? Well, they will want to go to higher management. They may want to discuss things with the internal or external auditors. They may want to discuss things with the directors or those charged with governance. They can also seek legal counsel or go to SICA for some assistance. Okay, that brings us to the end of part 2 of the code. Now we're going to move on to part 3 of the code. Remember, part 3 of the code deals particularly with chartered accountants in public practice, meaning that they actually sell the services of accounting. The first section of part 3 actually starts off with just a little recap of what we already went through with regard to the framework of fundamental principles, threats, and safeguards. We want to look at conflicts of interest. So we've already discussed conflicts of interest in some detail when we went over chartered accountants in business. But just to recap, chartered accountants may face conflicts because they offer different types of services. What types of services, you may ask? Well, they offer audit services, review, taxation services, and advisory services. If they are offering these services to the same entity, this will create a conflict of interest. Chartered accountants should not allow a conflict of interest to be created. Remember, we dealt with 2 types of threats. The first threat is when the chartered accountant offers services to 2 different customers and those customers have conflicting objectives or conflicting interests. This may be likened to offering audit services to 2 competitors in the same sector. The second type of threat is where the chartered accountant has a difference with their customer. So the chartered accountant views a specific issue very differently to their customer. So, for example, in financial reporting, a chartered accountant may look at land and buildings and consider it to be PPE, but the customer that they are working with may want it to be recognized as investment property. This is a difference in opinion between the chartered accountant and the customer that they are working for. This is a type 2 threat. A chartered accountant wants to try and identify the conflicts of interest as quickly as possible, particularly before they take on a new client. How do they do that? They need to look at the nature of the relevant interests that are being created and the relationships that will be created from a new client. They also want to look at the size and implications of the services that are going to be offered. In evaluating the different types of threats, a chartered accountant may want to take into account separating their business, meaning that the tax department is separate from the audit department. This can be done to create barriers of confidentiality. They also want to look at the policies and procedures that they have in place, and they want to ensure that information is kept confidential both physically and electronically. What types of safeguards can they create to eliminate conflicts of interest? Well, they want to create policies, particularly dealing with conflicts of interest. They may want to ask their personnel to sign confidentiality agreements. They may discontinue some sort of service, so if they're offering both tax and audit services to the same company, they may want to only offer tax services and not the audit services. They also want to disclose any interest that they may have to all parties that are involved and then get permission from those parties to proceed. Next, we're going to look at professional appointments. Now, professional appointment is very important for the auditor because there is sometimes circumstances where the auditor may not be accurately or legally appointed. So when the auditor is looking for a professional appointment, they need to ensure that there is a legal vacancy before they are appointed. This will become more important when we deal with Companies Act next semester. What types of threats may be created? Well, there may be threats to integrity and professional behavior, such as undercutting one's competitors. Clearly, there's a self-interest threat here. When evaluating the threats, the chartered accountant wants to look at the nature of the client's business, the complexity of the operations, the size of the services that will be offered. This is all looked at when we're dealing with pre-engagement activities. What types of safeguards can be implemented? Well, the chartered accountant needs to ensure that there's significant staff and resources in order to service the client. They may want to use experts where necessary and agree on realistic timeframes for performance of work. In rare cases, there may be changes in the professional appointment. The chartered accountant needs to re-look at the professional appointment from scratch when there is a change. For example, a chartered accountant may be appointed as an auditor in year 1, but they may be reappointed in year 2. This is a change in the appointment. So the chartered accountant in year 2 will have to do the same exercises such as pre-engagement activities before they accept the engagement again. Second opinions. Second opinions is when a client goes to a different chartered accountant to look for a different opinion. This normally happens with audit. So when a client gets a modified audit opinion, they then want to go to a second auditor to see if they can't change that to an unmodified audit opinion. What types of threats are created? Well, there's a self-interest threat for the accountant that is doing the work second because they can actually gain some sort of business from or recurring business from this client if they give them a good opinion. There's also threats to professional behavior because you don't want to contradict someone who is in the same profession as you. This may be considered to be a criticism of the first opinion. How should the chartered accountant safeguard themselves when it comes to second opinions? Well, the first is that they want to indicate any limitations that they have on their opinion to the client. So, for example, if you say that you are not replacing the opinion or this opinion cannot be used as the official opinion, that is a limitation. Obtaining the client's permission to contact the previous provider of the first opinion may be a good idea, and providing the existing or predecessor auditor with a copy of your opinion before you provide the client with such a copy. Fees and remuneration. There is a major risk that is being created by fees and remuneration. So many chartered accountants in practice only get paid when they have performed their duties. Sometimes you may get a client that won't pay you unless you give them a good opinion. You may also have a client who gives you a higher fee in order for you to accept more risk. This is considered to be bad. So we need to, as a chartered accountant, look at whether the fees that are received fairly remunerate us for the work that has been done. We don't want to overcharge or undercharge anyone because that affects the market negatively. We want to always try and adjust the fees that we receive based on the scope of the engagement. This needs to be done with all clients. The next is the client may offer you what is called a contingent fee. Contingent fees are fees that are calculated on a predetermined basis relating to an outcome of the work that is going to be performed, or as a result of a transaction that arises from the service that you are providing. This basically means that you are only paid based on some future outcome. As a chartered accountant, we want to move away from contingent fees. We don't want to charge contingent fees. Why? Because that creates a self interest threat for our objectivity. We will act in such a way to ensure that we get paid. How should we evaluate this type of threat? Well, we want to look at the nature of the engagement, the range of the fee amounts. So, how contingent is the fee? Is there any basic fee? What is the quality control procedures that are in place in order to make sure that our judgment is not affected? And are we adequately being reviewed or overseen when we are doing our work? We want to also create a written agreement between us and our client to ensure that they understand that some fees will be paid. So that we call that the basic fee. And then we want to attempt to get the work that is performed by us reviewed by an independent third party. Referral fees are where we receive a fee for giving some sort of information to someone else. You can often think about this very similar to the Avon case, where someone, when they refer someone to Avon, they get a commission for referring them to Avon. Now, these fees, unlike contingent fees, they are not outlawed, right? So we can accept these types of fees. We can accept commission fees as long as we notify all parties involved that we are going to receive a commission fee for referring them to someone. This needs to be done prior to the referral. Gifts and inducements we've already done in detail when we spoke about chartered accountants in business. So let's look at custody of assets. Custody of assets is a case where a chartered accountant has to hold someone's money or some other type of asset for a specific amount of time. This often happens when there's a merger and acquisition, where we are administering the merger and acquisition, which means we are going to take money from our one client, hold it until our other client is ready, and then pay it out. What is our responsibility with regard to holding clients' assets? Before we receive the money, we want to ensure that everyone understands where the money is coming from. We want to make sure that the sources of the money is not illegal. We don't want to be a vehicle for money laundering. After we take custody of the money, we should keep the client's money or assets separate from our own assets. We don't want to use such assets for any other purpose except the purpose that they have been given to us for. At all times, we need to prepare an account with regard to what happens to the money, where's the dividends, where's the interest, where's the income. We also want to comply with relevant laws and regulations that relate to the holding of these assets. We should never accept money unless we know that there are no significant threat to the fundamental principles. What are some safeguards that we need to implement when holding our clients' assets? Well, the first is we don't want to indicate that they are in trusts, because we are not, generally chartered accountants do not operate as trusts, and so we don't want to make them seem as if they are in some sort of trust. A trust is a legal term, it's a tax term, and so there's certain tax legislation and certain legal legislation that applies to trusts. Just by using that word in trust, we can sometimes mislead our clients. We want to mention the banks that have the money in them. So we want to indicate which bank holds the money. This may mean that we put it in a separate bank account, but in the same bank that we are using. We also want to account for it appropriately and distinguish the firm's normal business accounts from the special account where we're holding the money. We want to deposit the client's money without delay quickly into the client's account so that the client is able to earn as much interest as possible. We don't want to hold the money indefinitely. We must always only take custody of the money when we know when the money is going to be used and for what it will be used. We want to perform a reconciliation of the bank account where the money is held to our general ledger so that we don't lose any money and that we know exactly where the money is going. So, we are again at No-clara, or non-compliance with laws and regulations with regard to a chartered accountant in public practice. This is very similar to what we have already seen when we dealt with the chartered accountant in business. So basically, let's just recap the 5 steps that need to be applied. First, the chartered accountant needs to obtain an understanding of the matter that is at hand. This may mean the nature of the non-compliance, the circumstances that led to the non-compliance, the laws and regulations that are applicable, and the possible consequences that may come about because of the non-compliance. Remember, we said that the chartered accountant can use their professional judgment in determining the consequences. The next is they want to try and decide how the matter should be addressed. Remember, we want the chartered accountant to look at communicating with others. We want the chartered accountant to look at reporting the non-compliance to some sort of body. They must try and rectify the non-compliance. They must prevent future non-compliance. And they must also prevent non-compliance that has not yet happened or in a sector that has not yet happened. They then want to identify if there's any further action needed. So what else do they need to do in order to remedy the situation? This may entail looking at the urgency of the situation, the pervasiveness of the situation, how many people is it going to affect, is there any loss of life or is there any substantial harm that is going to be caused. They then want to disclose the non-compliance to the authority. Remember, when they're disclosing it to the authority, they want to look for if it's dealing with some sort of dishonesty, such as bribery. Will it cause some sort of threat to the license or the operation of the entity? Are we a listed company? Because if we are a listed company, if we are a public company, we need to be held to a higher standard. Did we sell any harmful products that are currently harming people? Or are we promoting some sort of scheme that aims to evade tax? And then finally, step 5, we want to try and document everything that we have done so that we cover ourselves. Remember, we document how we communicate to the people, we document the judgments that we've made, and we document that we are satisfied that we have executed our responsibilities in this regard. So that is what we need to look at when we're dealing with non-compliance and a chartered accountant in public practice. Join me next time when we'll be looking at part 4 of the Code of Professional Conduct, and that video is going to be a short video where we just look at mainly examples that we can apply to part 4 of the Professional Code of Conduct. Thank you and see you back next time.